All right, so that was your ABC of how to begin your investment journey, and frankly, that advice is for you whether you're a man, woman, for everyone. But to speak more on this, and because today we also want to focus on women's participation in the markets, in mutual funds, and in the industry, I'm speaking with Radhika Gupta, MD and CEO of Edelweiss Mutual Fund. Radhika, thank you so much for joining us. Always a pleasure to speak with you. I want to understand whether this has now become more of a norm, women mutual fund managers, more women participating in the mutual fund boom, or is this something just in our perception? What's the ground reality in your view?
I think it's a little mixed, and you have to separate the two issues. One is women participating in capital markets and funds, and one is women being employees and being fund managers and CEOs and all of that in the industry. I think on the first one, which is women investing, we have made a lot of progress. I agree with a lot of the introductory comments. Today's young millennial or Gen Z female investor is part of a lot more of an aspirational India. She is increasingly working. This whole concept of Atmanirbharta and financial independence is important. And there are both women financial advisors, platforms, women-focused conversations. So increasingly, even if you look at the data that AMFI is releasing, young women investors are a very fast-growing lot. And I think that is very encouraging data. And from all the data I see, they also tend to be a pretty responsible lot in terms of their investing patterns. And I can share some data with you. So I think on that front, we are making progress and we will continue to make progress. On the second front, I think we've made a little less progress. I always quote the number that if you look at 45 asset management companies, between the core leadership roles of CEO, CIO, COO, all these 5-6 roles, you should have about 300 positions in leadership. I doubt even 10-15 of them are filled by women. So on that front, I don't think we've made as much progress as we should have. It's ironic because if you look at the banking industry in our country, at some point, a lot of the country's banking assets were run by women. That hasn't translated as well to women fund managers and women in the asset management industry.
In fact, I was just looking at this data, and we'll play out a report by my colleague Saloni Kothari in a bit. But this Morningstar report says that among total managers of 473, this is the Women Fund Managers Report 2024, out of 473 managers in all, 42 are women, while 431 are men. Only 8.88%, all right, let me just round it off to 9%, of fund managers are women. Total assets managed by women is 6.66 lakh crores, which is only about 13% of overall assets. I want to understand the whys of it, Radhika, because it's not as if there are too few women going into the pipeline of the financial industry. Or those who are graduating from colleges, etc. Those numbers aren't that skewed. And you're talking about the CIO, CXO level, but even at the fund manager level, there is such a huge gap.
It is, but I'll come to the why of it, but I should make a point here that every year on Women's Day, I see these reports about women fund managers. When you do reports on the asset management industry, I would encourage everyone to do reports on asset management companies as a whole, because with due regard to fund managers, an asset management company is not just made by investment professionals. It's made by the people who sell on the ground. It's made by the people who manage money, the people who go crazy to service that money, the people who launch products, and women are unrepresented across the spectrum. So I don't know why we call out only fund managers every year. I find it a little bit bizarre. Now, as far as why, I think there are a few reasons. One is if you look at the origins of fund management, it was largely capital markets, and Dalal Street and the popular perception tends to be a little alpha male. So I think that it just is. You go watch a movie called Bazaar in Hindi or a movie called Wolf of Wall Street in English. and you'll start to see half the problem. Because where do fund managers come from, right? They come from capital markets. And I think that is the difference. Women bankers still are represented very differently, but capital markets is just presented in a very, very different way. I don't think the pipeline is as good as you make it out to be. I mean, even when we try and hire, and we are in AMC with 4 women CXOs and 32% women overall. So, we hit the mark on many stats. Even when we try and go out and hire women fund managers, the pipeline is not very large. It's probably better at an analyst level, but there's a lot of dropout in the 30s and 40s. So even just the pipeline to choose at the fund management level is not that high.
That's unfortunate if the pipeline is not that high, because I think, I don't know if you need an alpha kind of a personality, or
you don't.
The assumption that women can't have that alpha personality, it's all very skewed. So I'm sure it will change soon. But since I have you here, Radhika Gupta, I must ask you about what's happening in the industry right now.
Yeah.
And for the entire space, it's a time of flux, I would say, in a sense. AMFI is coming down, of course, guided by SEBI, on the kinds of investments going into small and mid cap. The idea broadly is to protect investors. How do you see these developments? And are we seeing a situation now that AMCs have to rejig their investments to stay in line with what the directions are? Is there a lack of clarity, or are you clear now on what comes next?
So I think we're clear on what we have to do. In fact, before this conversation, I was reviewing the mid and small cap disclosures for our own AMC in a meeting, because they have to be out on 15th March, if I'm not wrong. Look, I think what AMFI and SEBI are doing is prudent. A lot of money has come into a certain category. It is a higher risk category. And the last thing you want is that all this money comes into the category and you have an unforeseen situation around liquidity. We actually welcome this move, because we've always believed in our own funds that liquidity is of prime importance. In fact, we published this information in our presentations and fact sheets. And there is nothing wrong with taking any kind of risk, as long as you're taking that risk with your eyes open. I've increasingly worried that so much money that comes into the industry and into mid and small caps is 1 year performance chasing. Literally, you'll have the top performing small cap fund in the charts and people will just flock to it. And the reality is 50-60% returns in 1 year don't repeat themselves. It's not sustainable. So I think the best thing, and SEBI on AMFI is not coming out and saying stop flows into small cap funds, don't invest. They're just saying this is the data, invest with your eyes open, buyer beware. And I think the data is not going to, I looked at the data for our own fund house and it doesn't look scary at all. There's no rejigging that we need to do. So it is business as usual. And if you paid attention to liquidity, I don't think the disclosures and the action is going to require anything. If you didn't, then I think it will require some attention, but that's not necessarily a bad thing.
Yeah. So just to get your view on this, Radhika, we put out a story about the circular that AMFI has sent to mutual fund trustees to conduct stress tests, like you said, for the 15th of March. And the parameters there were MFs to assume peak traded volume at 3 times daily average, to assume 10% participation of peak daily volumes, liquidity based on days taken to sell stocks at 10% participation, and mutual funds to calculate liquidity based on top 80 most liquid stocks. You also have to disclose liquidity of 25% and 50% of the portfolio. Is this on the lines of what you have received? Can we confirm that with you? And is this doable?
It's fairly accurate, and it's, as I said, I just saw the disclosures for our own fund house about half an hour ago. In fact, I would argue the disclosure is a tad generous, because it's not 80, it's 80% of the portfolio it lets you see. So it lets you exclude 20% of the most illiquid part of the portfolio. So it's actually quite generous in a disclosure.
Okay. Just one more take on this before we take a very short break, Radhika, is for investors who are watching this and who have bet on small and mid cap funds, obviously because you have seen far superior returns, what is the messaging going out for them? Because many are perhaps wondering whether you're going to see a bit of a downturn. You're seeing pain points in the markets as well. What would you say to them?
So it's a great question because I don't think the messaging also of this movement should be mid caps and small caps are overvalued, have a sense of panic. I don't think that should be the messaging. That's not the intent of the messaging. The messaging should be one, if you have put money into these categories, and they are great categories. A lot of our portfolio is mid and small cap as well. They're great categories for the future. Have realistic expectations when you put money. I repeat, the last 1 year number of any category on the website these days looks like 50-60%, not sustainable. Second is, within the gambit of mid and small cap funds, there is a certain degree of nuance. It's like when you are looking at fixed income, credit risk, liquidity risk matter. When you're looking at mid cap funds, there is something called concentration, there is something called liquidity. These are things that matter. There is something called redemption risk. So I think the idea is for people to become more aware investors and to be, I think it's good. The more questions we ask before investing, the less questions we'll have to ask after investing. And that's a better investing experience. So I think that's the message. It's not mid caps are overvalued. Don't invest in mid caps, go redeem your mid caps. That should not be the message at all.
Yeah, absolutely. And that's important because, that's where you're going to see the growth coming in, or, in well-managed funds, at least you definitely will. Please stay on with us, Radhika. Viewers, it's time for a very short break, but we're coming right back with, Radhika Gupta's outlook for what are going to be the best performing categories, how she sees the markets going, and a lot more. Welcome back. You're watching the Mutual Fund Show, and we have a very special guest today, Radhika Gupta, MD and CEO of Edelweiss Mutual Fund. Radhika, of course, we're talking, in our Women's Day special, but I want to bring the focus on the sector, the industry, and also what's happening in the markets right now. With a slew of action that we've seen from regulators, whether it's IFL, it's JM Financial, Paytm before that, a lot of focus on two things. One, whether any of these stocks are in mutual fund portfolios from the investor point of view. And also, what is the outlook on the financial sector? Is the regulator going overboard, or is there really some things which need to be cleaned up? I just wanted you to weigh in.
Look, so I think whether the stocks are in mutual fund portfolios, the data is well known and people will take individual stances on individual companies. And I think as far as mutual fund portfolios, there often is too much scrutiny because most mutual funds run extremely diversified portfolios where even if these stocks, and I'm not talking about us, they're 2-3% weight. So, in financial services, regulatory action is a big one. In pharma or in healthcare, FDA action is a big one. So I think that risk exists. And, you can't scrutinize mutual fund portfolios with every stock. So unless there's a really systemic problem. As far as I think, and, I won't go into companies, but, some of the regulatory action that you named, I think that it has been a practice in financial service. This sounds very obvious to say, but the reality of running a financial services business is that it is going to be highly regulated. And the fact is, world over in financial services, regulatory intensity has only increased, not decreased, post 2008. So I think that is the reality that we operate in, and all of us will have to up our standards of compliance, whether we are an exchange, whether we are a asset management company, whether we are an NBFC or whether we are a fintech. And I also think from a startup point of view, seeing startups in another role at Shark Tank, I always say that if you're a startup in the financial services space, regulatory compliance is something that you don't take risks with. You don't even call it hygiene. You always say, I want to ace regulation. So that is my take on it. It's part of doing business in this industry, and world over in financial services, compliance will increase.
Compliance will increase. Then the natural question is that why are there so many companies, large storied companies and brands, being found falling short of compliance?
It's a question that is difficult to answer. It's a question that is difficult to answer. I think one of the things that has happened is that the quality of technology in our regulatory systems, whether SEBI, RBI, has really gone up. And I mean, this is praise to our regulators. And perhaps it's a signal to industry that we have to do as good a job. You know, our regulators have not only caught up, they're ahead of us in terms of the work on technology. I know our SEBI chief keeps talking about the power of data and the role of technology. And I think the work, some of the work they've done on algos has been outstanding. And so perhaps that's why you're seeing that now, you know, before regulatory compliance was something you caught in an inspection. Now I think their access to data, their algos makes the ability to catch things far quicker, almost live, and with a lot of data to back up those answers. So I think that is something that as an ecosystem, we have to be increasingly more prepared for.
Absolutely. Thank you so much, Radhika Gupta, for joining us today. Fantastic having a conversation with you, as always, on all days, and not just on Women's Day. But great to speak with you and hope to have you back soon. That's all the time we have on this edition of the Mutual Fund Show, but stay tuned. A lot more coming up on NDTV Profit.